In 1973, the US quietly abandoned the gold standard, not with a crash, but with a press release. It marked the end of a promise that every dollar was backed by something real. From that moment on, money became belief, and belief is fragile. Within 5 years, oil prices quadrupled, inflation hit double digits, and trust in the American system began to fracture, not at the edges, but at its very center. Yet the headlines told a different story. Temporary shock, Arab embargo, supply constraints. But underneath, something deeper was unraveling. The real cause wasn't across the ocean. It was structural, domestic, self-inflicted. Washington had made 5 silent assumptions, each one fatally wrong. Together they created a trap, an invisible mechanism of debt, consumption, and denial that would define the next decade. And now, 50 years later, we are walking straight into it again, not by accident, by design. In the early 1970s, America believed it could print money, spend freely, and outsource its deficits to the future, without cost. It worked until it didn't. When the illusion broke, the backlash was brutal. Recession, unemployment, a loss of global status. Today, those same illusions are back. The difference? The numbers are 10 times larger, the debt 30 times deeper, and the political buffer nearly gone. We are repeating the 1970s formula with surgical precision, as if history were a script we never bothered to edit. And now imagine, what happens when belief breaks again? Most people still think inflation is the issue, or that interest rates alone can fix it. But the real risk isn't monetary, it's systemic, institutional. The architecture of confidence is eroding, quietly, steadily. Some economists say this is just a cycle. Others warn it's a countdown. The patterns are too exact to dismiss, and the stakes too high to ignore. By the end of the 1960s, the United States stood at the peak of its post-war power. It controlled nearly 60% of global gold reserves, commanded half of the world's industrial output, and dictated the rules of international finance. The dollar wasn't just a currency, it was the bloodstream of global trade. And behind it stood a promise. Every dollar could be converted into gold at $35 an ounce. But that promise was quietly bleeding. The Vietnam War was draining fiscal reserves. The Great Society programs, launched under President Johnson, expanded federal spending at unprecedented levels. Politically, both initiatives were popular. Economically, they were unsustainable. By 1971, America was spending far more than it produced, and paying for the gap by printing dollars. The result? Foreign central banks were holding more and more dollars, and getting nervous. France was the first to act. President Charles de Gaulle, sensing that the U.S. could no longer honor its gold commitment, demanded conversion of his dollar reserves into bullion. Other countries followed. Gold began to leave Fort Knox, quietly, then rapidly. Confidence cracked. And on August 15, 1971, President Richard Nixon made a decision that would alter global economics. He suspended the dollar's convertibility into gold. Temporarily, he said. It was never reversed. That single announcement marked the end of the Bretton Woods system, a framework that had anchored global currencies since 1944. Suddenly, the dollar was backed by nothing but the faith of its users. And yet, no new system was put in place. There was no plan B, just improvisation. Imagine removing the steering wheel from a moving car and hoping momentum would be enough. In this vacuum, a new kind of economy began to emerge. Untethered from gold, money became cheaper to create. Credit expanded. Debt became easier to ignore. Consumption rose. And with it, the illusion of perpetual growth. But the foundation was unstable. Inflation, long dormant, began to stir. Between 1965 and 1970, it hovered between 1% to 4%. After the decoupling from gold, it surged. By 1974, consumer prices were rising at over 12% annually. Wages couldn't keep up. Savings eroded. Pensions shrank in real terms. The middle class, once America's pride, began to feel pressure for the first time in a generation. The official narrative pointed to external shocks, the oil embargo, OPEC, geopolitical tensions. But these were symptoms. The deeper cause was internal, monetary expansion without limits, fiscal promises without discipline, and a political system that feared the short-term consequences of honesty. Some historians believe the 1970s were an accident of circumstances. Others argue they were the logical outcome of policy. And here lies the hidden thread. When money detaches from reality, consequences don't vanish, they simply delay, until they return with interest. What made the 1970s so destabilizing wasn't just inflation. It was the breakdown of a shared understanding of value between government, markets, and citizens. The social contract frayed. People no longer trusted that tomorrow's dollar would buy what today's did. And once trust fades, control becomes impossible. The breakdown began with a number, $60 billion. By 1971, that was the size of the US dollar overhang held abroad. Paper promises the United States could no longer convert into gold. At the same time, the country had only about $10 billion worth of gold reserves available for redemption. $6 promised for every one physically stored. This was not just an imbalance, it was a confidence time bomb. Foreign governments understood the arithmetic. Quietly, they began to redeem dollars for gold, until Nixon shut the window. But stopping convertibility didn't fix the imbalance. It simply erased the measurement. Now the dollar floated freely. No peg, no anchor, no ceiling on how much could be printed. The U.S. made its choice, to inflate its obligations away rather than pay them off. And inflation came fast. In 1971, inflation stood at 4.4%. A year later, 6.2%. By 1974, it had doubled again. This was no longer gradual, it was structural. The Federal Reserve responded late and timidly. Interest rates remained well below inflation through most of the decade. Why? Because raising rates would slow the economy, and politically, that was unacceptable. So the real value of money fell month by month while wages stagnated. Imagine saving for 20 years and watching half the value evaporate in 5. But inflation wasn't the only crisis. Energy prices spiked after the OPEC oil embargo in 1973. The price of a barrel jumped from $3 to over $11 in just a few months. Gas lines stretched for blocks. But again, the embargo was not the root cause. It was the trigger that exposed a deeper flaw. The U.S. had become dangerously import dependent, not just in oil, but in manufactured goods. Trade deficits ballooned. America was buying more than it sold and financing the gap with debt. What once had been an industrial surplus nation was becoming a consumer credit empire. And then came the fatal mistake. The government tried to control the consequences without correcting the causes. In 1971, Nixon imposed wage and price controls, a move unheard of in peacetime. The idea was to stop inflation by decree, but prices are not switches. They reflect deeper forces. Within months, shortages emerged. Goods vanished from shelves. Producers cut output, and inflation came back even stronger. The system was signaling distress, and the response was to muffle the alarm. This is the turning point most economists miss, because beneath all the policy errors was a single assumption, that the U.S. could defy gravity, economically and geopolitically, that deficits didn't matter, that the dollar would remain supreme no matter what backed it. And this assumption shaped everything. Public spending increased, even as revenues lagged. Military budgets stayed high. Social programs expanded. Politicians promised more, borrowed more, and worried less. Debt became the hidden fuel of growth. By the end of the decade, the national debt had doubled. Corporate debt tripled. Consumer credit exploded. What used to be a safety net became a permanent fixture. Debt stopped being a temporary tool and became a structural necessity. But the most dangerous shift wasn't in numbers. It was in mindset. America stopped asking whether it could afford something. It only asked whether it could postpone the cost. That shift, from reality-based economics to narrative-based finance, would define the next 50 years, and it began here. To understand how the trap was built, we have to look at the mechanics, not just the outcomes. Because inflation, debt, and stagnation weren't isolated events. They were outputs of a system that had quietly rewired itself, step by step. First, the detachment of money from value. When the dollar was unpegged from gold, it became elastic. The money supply, once constrained by physical reserves, was now determined by policy. In practice, this meant the Federal Reserve could expand credit at will, and it did. From 1971 to 1977, the U.S. money supply, M2, nearly doubled. Money flooded the system. But it didn't go everywhere equally. Credit flowed where returns were easiest, to financial markets, real estate, and government bonds. Not factories, not research, not wages. And here's the trap. Money creation fed consumption, but not productivity. People had more to spend, but the country wasn't producing more to sell. That imbalance created pressure. More dollars chasing the same goods. Prices rose. But policymakers hesitated to act. Raising interest rates would have tamed inflation, but also risked recession. So they delayed. Delay became default. Second, debt as policy, not emergency. Government spending continued to rise, but revenues didn't. The Vietnam War, Medicare, social programs, none were scaled back. Instead, the Treasury issued more bonds. Investors, foreign and domestic, kept buying, trusting that the U.S. would always pay. But with what? New debt was used to pay old debt. Interest became a budget line. This wasn't a flaw in the system. It was the system, like an engine that runs hotter the longer it runs until one part fails. Third, wage-price dynamics broke. Traditionally, productivity gains translated into higher wages. But with inflation outpacing both, workers lost ground. Labor unions negotiated automatic cost of living adjustments, wage indexing, to keep up. But this created a feedback loop. Higher wages, higher prices, higher wages. Economists call it the wage-price spiral. It's not a metaphor, it's math. And it was fueled by expectations. If people believe prices will rise, they act accordingly. Businesses preemptively hike prices. Workers demand more. Banks tighten credit. The entire economy becomes reactive, not productive. Fourth, the illusion of control. The Federal Reserve, caught between political pressure and economic data, tried to steer both inflation and growth. But its tools were blunt. Interest rates, reserve requirements, and open market operations. These were levers, but the machine they operated had changed. The Fed could influence short-term lending, but it could no longer dictate where money flowed. Deregulation and financial innovation had already begun. Money was moving faster and in new directions. Wall Street was rising. Manufacturing was shrinking. Fifth, global feedback. America's internal choices had external consequences. As the dollar weakened, other nations began to adjust. Some devalued their own currencies to stay competitive. Others accumulated dollars to defend their exports. The result? A global loop of imbalance. The U.S. consumed, the world produced, and dollar-denominated debt became the common thread. This was no longer just national policy. It was a global system, with America at its core, absorbing goods, exporting inflation, and borrowing to sustain it all. And still, the belief held that somehow this machine would self-correct. But machines don't correct beliefs. They obey input. If the input is cheap money, the output is distortion. And by the late 1970s, the distortion was visible everywhere, in prices, in wages, in trade. But no one could agree on the cause. Some blamed oil, others blamed labor. Others still blamed foreign manipulation. But few were ready to admit the mechanism itself was broken. Because if you see the system clearly, you have to change it. The system didn't collapse, it calcified. By 1979, inflation had become an economic fact, not a policy error. It averaged over 11%, enough to double prices every 7 years. For households, it meant the erosion of savings. For retirees, it meant fixed incomes became sinking incomes. For businesses, long-term planning became guesswork. No one trusted the future value of money. The Federal Reserve, now under Chairman Paul Volcker, made a brutal choice. In 1980, the Fed funds rate hit 20%. Mortgage rates soared to 18%. Loans evaporated. The cure for inflation was recession, and Volcker delivered it, deliberately. Unemployment climbed to 10.8%. That's higher than during the COVID crash. Factories closed. Small farms went bankrupt. The housing market froze. It was the deepest downturn since the Great Depression. But inflation finally cracked. The cost was not measured in GDP. It was measured in public trust. The American middle class, once defined by security, learned a new language: layoffs, interest shocks, deindustrialization. For the first time in decades, upward mobility became optional, not expected. And something else changed, quietly: the role of finance. After 1980, money didn't return to labor or manufacturing. It flowed to capital. Deregulation opened new channels. Wall Street became the beating heart of the economy. Debt markets exploded, credit cards multiplied, financial services grew faster than any other sector. In 1980, finance made up 4% of US GDP. By 2000, it was over 8%. This wasn't recovery, it was mutation. America's economic engine had shifted from production to leverage, from building value to extracting it, from goods to instruments. And under it all, a new logic took hold. Growth must be constant at any cost, even if it meant borrowing against tomorrow permanently. The trap was now sealed, because the system could no longer function without debt. Consumers needed credit to maintain their lifestyle. Corporations needed leverage to boost returns. Governments needed borrowing to fulfill promises. And Wall Street turned this dependency into a business model. Debt wasn't a risk, it was the product. From 1982 to 2000, U.S. federal debt tripled. Corporate debt quadrupled. Total household debt hit $7 trillion. And no one seemed alarmed. After all, interest rates had come down. Inflation was under control. The pain of the early 80s had faded. But the structure had shifted. The middle class lost bargaining power. Real wages stagnated. Pensions morphed into 401ks, shifting risk from corporations to individuals. Healthcare costs soared. Housing became a speculative asset. Inequality widened, not as a side effect, but as a consequence. Because once the system favors capital over labor, the outcome is baked in. And still, the lesson wasn't learned. Instead of asking how the crisis emerged, leaders congratulated themselves for surviving it. Inflation was beaten, growth returned, markets boomed, but the deeper cost remained unpaid. A generation's economic security was replaced by volatility. Certainty was swapped for exposure. And the message was clear. Survival means adapting to instability. That wasn't a return to prosperity. It was the price of pretending the system still worked. Now look again, but look at today. The labels have changed. The dynamics have not. In the 1970s, inflation was driven by oil, wages, and debt-fueled consumption. In the 2020s, it's driven by supply shocks, global fragility, and debt-fueled consumption. The mechanisms didn't vanish, they evolved. The key difference? This time they're automated and magnified. After 2008, the Federal Reserve discovered a new tool: quantitative easing, a clean phrase for something old, printing money to buy debt. In the 1970s, that idea was too dangerous to say aloud. In the 2020s, it became central policy. Between 2008 and 2022, the Fed's balance sheet grew from $900 billion to nearly $9 trillion. Money flowed, markets rose, but productivity didn't. The same mistake repeated. Wages inched upward, but inflation moved faster, again. Consumer debt crossed $17 trillion. Federal debt exploded past $34 trillion. In real terms, that's more than triple the 1980 level adjusted for inflation. The economy grew, yes, but increasingly through leverage, not output. Then came the illusion breaker, COVID. In just 1 year, the U.S. government injected over $5 trillion into the economy. Stimulus checks, emergency programs, corporate bailouts. Necessary, perhaps, but not without cost. Suddenly, the bill came due. Inflation, dormant for decades, returned. First 4%, then 6%, then 9%. And again, policymakers called it temporary, just like they did in 1973. But inflation never announces itself as permanent. It seeps in through rent, gas, food, through hidden costs and silent shortages. And once it embeds in expectations, the spiral begins. Now compare. Then it was called wage indexing. Today, automatic cost of living adjustments. Then it was energy shocks. Today, supply chain disruptions. Then it was a gold exit. Today, a credibility exit. Because here's the truth. The modern dollar isn't backed by gold or oil or productivity. It's backed by expectations that the system will keep functioning, that the Fed will respond, that debt will always be serviceable. But expectations are not infinite, and in 2023, they began to crack. As interest rates rose to fight inflation, the cost of debt servicing ballooned. In 2024, the US government spent more on interest than on defense. That's not a policy shift, that's a structural warning. And corporations? They borrowed heavily during the cheap money years. Now, refinancing comes with higher rates, or not at all. Defaults are rising, layoffs are creeping in, and consumer credit delinquencies are ticking upward, quietly but steadily. The trap is visible, because just like in the 1970s, the system now depends on something it can no longer afford: cheap money. Raise rates and you slow the economy. Lower them and inflation returns. Hold them steady and the debt quietly corrodes the future. That's not a policy dilemma. That's a design flaw. And underneath it, the same 5 fatal errors: spending beyond output, printing beyond discipline, consuming beyond borders, borrowing without brakes, and believing that a narrative can outlast a mechanism. But systems don't respond to belief. They respond to math, and the math is turning. Every metric that mattered in the 1970s, debt ratios, energy dependency, wage pressure, interest burdens, is flashing red again. But now they're layered on top of a digital, globalized, and far more fragile financial system. And still, the assumptions hold: that the dollar will remain central, that debt can grow forever, that volatility is manageable. Assumptions held until they weren't. That's how it worked in 1979. And history doesn't need to repeat, it just needs to rhyme. This time, the echo is louder, and the margin for error smaller. If this helped you see today through the lens of yesterday, tell me where you're watching from. History doesn't crash, it compounds. Crisis is rarely a single event. It's a slow arrangement of familiar parts, aligned just slightly differently, until the system they support can no longer pretend to function. That's what made the 1970s so dangerous. Not the oil embargo, not even the inflation, but the belief that the rules no longer applied, and that the consequences could be deferred. Today, we're not just repeating that belief, we've institutionalized it. A generation grew up thinking low rates were normal, that asset prices only go up, that the Fed could absorb any shock, and that the dollar, no matter how strained, would remain the axis of the world economy. But systems built on delay don't collapse cleanly. They break where pressure was ignored the longest. For America, that pressure is building where few are looking: in trust, in the quiet agreement between people, institutions, and their money. Once broken, it doesn't return on command. That's what 2026 threatens to reveal. Not a crash, but a reckoning. The return of cause and effect, the moment when narratives can no longer cover for arithmetic. And this time, the escape routes are narrower, because in 1979, America still made things. It still had fiscal space. It still had time. Today, it has momentum, but no cushion. Speed, but no brakes. The trap was never just about debt or inflation. It was about forgetting the cost of forgetting. If you're the kind of person who doesn't trust headlines, but wants to understand what's really driving the economy, power, and history, this channel was made for you. Here, every episode connects past financial events with today's hidden mechanics, so you can see the system from the inside, not just follow the surface news. Subscribing isn't just about getting updates. It's about building a long-term lens to recognize patterns before they repeat. Because once you understand how power really works, you stop being surprised by crisis and start preparing for what comes next.